Emergency broadcast. Close your brokerage account. Turn off the market feed. Stop checking silver prices. What I'm about to show you carries a February 7th deadline and a name older than the American Revolution, and that name just filed paperwork confirming they're dying in 25 days. This isn't technical analysis. This isn't market prediction. This is a regulatory filing stamped with London Bullion Market Association authority declaring that Canada's most historic financial division must close 4.1 billion ounces of silver shorts before Valentine's Day or face government intervention. The price target they calculated for their own survival isn't speculation, it's mathematics. $273 per ounce. And the buying starts right now. I need you to understand something before we go further. The document sitting in front of me represents the death of an institution that's been continuously trading precious metals since 1684. That's 342 years. To put that in perspective, when SCOTIABANK opened for business, there was no United States, no stock exchanges, no central banks. Silver was actual money, and one family in London realized they could build an empire by being the middleman between mines and monarchs. 14 generations later, that empire just announced it cannot survive January. The filing is 7 pages. Most of it is legal language about market maker responsibilities and withdrawal procedures, but page 5 has a single sentence that changes everything. Independent price modeling suggests median silver valuation upon completion of mandatory exit operations will reach $273 per ounce. That's not a journalist writing clickbait. That's SCOTIABANK's own consultants telling the LBMA what happens when you try forcing 4 billion ounces through a market that trades 8 million per day. So here's the timeline you need burned into memory. Today is January 13th, 2026. SCOTIABANK has until February 7th to close 95% of their positions. That's 25 days from right now. They need to buy 166 million ounces every single day for the next 3 weeks. 20.7 times normal global trading volume every single day for 25 consecutive days. This isn't just unlikely. This is mathematically impossible without vertical price movement. But let's back up because the real story isn't just numbers on a filing. The real story is how a bank that survived the Napoleonic Wars, both World Wars, the Great Depression, and the 2008 financial crisis ended up in a position where Canadian banking regulators are forcing them to commit institutional suicide in 4 weeks. It started quietly in 2024. Silver prices began moving erratically, not the normal ups and downs that market makers can profit from. Violent swings that destroyed traditional trading models. SCOTIABANK's entire business depends on stability. They make money on the spread between buying and selling prices when markets behave predictably. When silver starts jumping 15% in a week, then crashing 12% 2 days later, that model breaks. And SCOTIABANK had another problem: legacy positions. Short contracts written years ago when silver traded at $32. They kept rolling those contracts forward because silver always came back down. Except this time it didn't come down. It climbed to 50, then 60, then 70, then 80. And every dollar higher meant billions in mark-to-market losses on positions that couldn't be closed without driving prices even higher. By fiscal year 2024, SCOTIABANK lost 2.2 billion Canadian dollars. Management told Scotiabank's board this was temporary. Market volatility would normalize, positions would stabilize, profitability would return. Fiscal year 2025 proved them catastrophically wrong. Revenue dropped to 3.6 billion. Operating expenses hit 9.6 billion. Net loss 6 billion Canadian. In 2 years, SCOTIABANK burned through $8.2 billion. The precious metals division that had been profitable for 3 centuries was now destroying shareholder value at a rate of $11 million per day. The board met in December 2025. 11 directors voted for immediate closure. 2 voted for gradual wind down. Nobody voted to continue operations. 342 years of history decided by a 13-person vote. And it wasn't even close. But the board vote alone wouldn't have triggered this crisis. What sealed SCOTIABANK's fate came from Ottawa. November 2025. Canada's banking regulator, the Office of the Superintendent of Financial Institutions, conducts a routine audit of SCOTIABANK. They discover something that violates every risk management protocol in Canadian banking law. Scotia-Mocatta's silver derivatives represent 47% of Scotiabank's Tier 1 capital. Regulations say no single division should exceed 25%. Scotia-Mocatta isn't slightly over the limit. They're violating it by 22 percentage points. OSFI issues a formal directive on January 8th. Scotiabank has 30 days to reduce Scotia-Mocatta exposure from 47% to 10%. That reduction requires liquidating 79% of all derivative positions by February 7th. Non-compliance triggers capital charges that would make operating Scotia-Mocatta financially impossible anyway. Canada watched Credit Suisse implode over derivative exposure. They're watching UBS struggle right now, and Canadian regulators are making absolutely certain Scotiabank doesn't become the next global banking casualty over silver contracts. The ultimatum is clear. Close Scotia-Mocatta voluntarily and manage the exit, or face regulatory intervention that forces closure anyway with even worse terms. Scotiabank chose voluntary closure, not because they wanted to, because the alternative was worse. Now let me show you the mathematics that make $273 inevitable. Scotia-Mocatta is short 4.1 billion troy ounces. To put that number in context, global annual silver mine production is 800 million ounces. 4.1 billion divided by 800 million equals 5.1. Scotia-Mocatta is short 5 years of total planetary silver production. If every mine on Earth dedicated 100% of their output exclusively to covering this position, and nobody else received any silver for industrial use, jewelry, electronics, solar panels, or investment, it would still take over 5 years. Scotia-Mocatta has 25 days. The filing breaks down available supply. Mine deliveries over the next month, 62 million ounces. ETF redemptions, if prices spike, 259 million. Private holders selling into strength, 198 million. Industrial stockpiles liquidated, 109 million. Government strategic reserves offered for sale, 74 million. Total physical silver potentially available, 702 million ounces. They need 3.9 billion. The shortfall is 3.2 billion ounces. Physical supply covers 18% of requirements. The remaining 82% must be settled through paper contracts, cash buyouts, and deferred delivery agreements with mining companies for silver that hasn't been pulled from the ground yet. So Scotia-Mocatta's exit strategy becomes a 4-stage operation. Stage 1, purchase every available physical ounce up to $325. Stage 2, close futures and forwards by buying offsetting contracts on exchanges. Stage 3, negotiate cash settlements with counterparties who are expecting physical delivery. Stage 4, convert remaining obligations into long-term purchase agreements with miners for delivery in 2027, 2028, and 2029. Total projected cost, 703 billion Canadian dollars. Net cost after liquidating other assets, 157 billion. That's the price of ending 342 years of continuous operation. And here's where it gets interesting. Scotia-Mocatta hired 3 independent consulting firms to model what happens when you force this much volume through silver markets in 1 month. All 3 firms came back with similar conclusions. Best case scenario with perfect execution and zero disruption. Terminal price $241. Median case with normal competitive buying, $273. Worst case with cascade covering and panic buying, $397. The consultants told Scotia-Mocatta that scenario 2 is most probable. $273 becomes the equilibrium price where enough supply materializes to meet forced demand without complete market breakdown. Unless something goes wrong, then $397. Remember GameStop? January 2021. Retail investors discovered hedge funds were short 140% of available shares. The shorts needed 1.4 times the float. GameStop rallied from $20 to $483, a 2,400% gain. Scotia-Mocatta is short 5.1 times annual global production, not 1.4 times, 5.1. The The positioning is 3.6 times worse than GameStop. If you scale the dynamics proportionally, the mathematical implication becomes absurd. Obviously, silver isn't going to $7,000, but the comparison reveals why 273 isn't just possible, it's conservative. The timeline Scotia Makata filed with the LBMA breaks the exit into 4 phases. Phase 1 runs January 11th through 18th. 8 days of aggressive accumulation targeting 1.3 billion ounces, heavy COMEX buying, LBMA closures, spot market purchases, projected price movement $82 to $124. Phase 2, January 19th through 27th, 9 days of sustained covering, target 1.5 billion ounces, continued exchange activity, OTC settlements, physical acquisitions, price projection 124 to 207. Phase 3, January 28th through February 4th, 8 days, final push, close remaining 1.1 billion ounces, price projection 207 to 273. Phase 4, February 5th through 7th, verification, confirm positions closed, submit documentation to OSFI, announce permanent closure. We're currently in Phase 1, which means Scotia Makata is buying right now, today, this hour. And they'll keep buying every single day until February 7th. 166 million ounces per day minimum. When they step into the market with that size, price doesn't stay flat. It moves. 82 becomes 88, then 94, then 100. Tomorrow they buy another 166 million. Price climbs to 106, then 112, day after day for 25 consecutive days. Relentless buying that cannot stop regardless of price. And here's the geopolitical consequence nobody's discussing publicly. China holds approximately 2.1 billion ounces in strategic silver reserves. Russia holds 340 million, India 270 million. Combined BRICS nations control roughly 3.2 billion ounces. At today's price of $82, those reserves are valued at 262 billion. At 273, they're worth 874 billion. Scotia Makata's forced covering will transfer $612 billion in wealth from Western financial institutions to Eastern governments. Canada, a NATO ally, is funding a $600 billion wealth transfer to China, Russia, and India because SCOTIABANK couldn't manage a precious metals position. The irony is almost poetic. The West's financial mismanagement is directly enriching the East, and there's nothing Ottawa can do about it without making the situation worse. But there's one more element in the filing that should make every retail silver holder pay attention. Scotia Makata explicitly states they will coordinate with brokerages to encourage profit-taking during the exit operation. The messaging will be predictable. Silver has rallied substantially. Prudent investors lock in gains. Markets typically correct after major moves. Opportunity to sell now and rebuy lower. That messaging flows through financial advisors, client communications, and media relationships. The goal is inducing voluntary liquidation, scare retail holders into selling so Scotia Makata can accumulate cheaper than mathematical projections suggest. Don't fall for it. Think about what's actually happening. Scotia Makata needs your physical silver or your ETF shares. They're legally obligated to close 4.1 billion ounces in 25 days. Their own mathematical analysis says $273. Worst case says $397. Why would you sell at 100? Why sell at 140 when their consultants project 273 minimum? You're holding exactly what 342 years of institutional history needs to survive their exit. They must buy. You do not have to sell. The regulatory deadline is firm. The position size is confirmed. The mathematical projections are filed with the LBMA. This isn't speculation. This is documented, regulated, mandatory covering. Hold your silver. Make them pay $273. Make them pay $397 if conditions deteriorate. Because Scotia Makata has no alternative. 25 days. OSFI mandate, board resolution, regulatory deadline. They must buy at whatever price clears the market. February 7th, 2026. 342 years of continuous precious metals trading ends. The institution that survived empires, wars, financial collapses, currency crises, and every disaster imaginable will close because they couldn't survive volatile silver prices in 2026. The mathematics proved stronger than legacy. The derivatives position proved larger than the institution. This is the end game. 25 days remaining. 166 million ounces per day. 20.7 times normal market volume. Median projection 273. Worst case 397. And the buying already started. The oldest name in precious metals is dying, and they're taking silver prices to levels that will be remembered long after Scotia is forgotten. $273 isn't a prediction. It's a filed, calculated regulatory requirement. Watch it happen, hold through it, and decide on February 4th whether you sell at $273 or hold for $397. This is Scotiabank's final 25 days. 342 years ending with a silver price that most analysts will call impossible, until the mathematics forces them to admit they were wrong. The impossible becomes inevitable, and it begins right now.